Let's explore how to grow idle cash to fund one's lifestyle. Are investments only for risk takers? How can one invest better to live easier today and better tomorrow? CPF Board already provides high returns for CPF members, but should you and how can you grow more money in your CPF accounts to secure your retirement nest egg? Can you trust Robo advisor to do the job? We will be inviting Mr. Samuel Rhee, Chairman and Chief Investment Officer of Endowus, to share his insights with us. Mr. Samuel Rhee is the former CEO and CIO of Morgan Stanley Investment Management in Asia. He has 27 years of institutional investing experience in Singapore, Hong Kong, and London. Endowus solves the biggest problems of wealth and investing, including retirement adequacy, which has led to the firm becoming the first and only digital advisor for CPF investing in Singapore. Let's invite Mr. Samuel Rhee, please.
Hi, everybody. It's a real pleasure to be here with EPPL and Precepts Group, and really wonderful to be joined by a lot of people today. Today I'll be speaking specifically about CPF investing and how to achieve extraordinary returns from your ordinary account. As an MAS licensed company, we have to have a short disclaimer. But also, I had an extensive introduction, so I don't think I need to reintroduce myself. But the team has come together to really solve an existing pain point that we all experienced, which is that we struggle to find, the best way to manage our own money and invest. So Endowus was set up to really help people save and invest better, and really help people invest better so they can live easier today and live better tomorrow. Endowus is where you grow all of your money. So as the introduction suggested, we are the first and only digital advisor for CPF investing, where we brought all of the offline investing experience online. Not only that, we introduced new products like passive index investing through your CPF at really low cost. So reducing costs was a real key mission for us so that people can achieve better outcomes. And since then, we've really grown the business this is our 5th year now, and we are backed by global strategic and venture investors, notable among them, obviously, the biggest private bank in the world, UBS. Their first investment in a fintech or a wealth tech company is Endowus in all of Asia Pacific. And we are the highest ranked robo-advisor, but we are more than just a robo-advisor. We're a total wealth platform to manage all of your wealth. The 3 pillars of investment success, regardless of who you are and how you're doing it, and what pot of money you're investing, whether it's your cash, or whether it's your CPF or SRS, the most important 3 things that we need as individual and especially retail investors is advice, access, and cost. Advice, because we need to have a plan that works for each individual. Everybody is different. Everybody is at a different stage in life. Everybody has different personal circumstances. Everybody has different amounts of money that they can invest. For CPF, we have some people using their OA for housing, others who have OA money sitting there in cash, just earning the 2.5%. Some people are hacking and putting money, topping up their SA, for example. So there's many ways to manage your money and your wealth, and it's a very, very personal experience. And so through technology, what Endowus is trying to do is to provide advice at a hyper-personalized level, give access to products that were previously not available here in Singapore, as I mentioned, like passive investing, index funds in CPF, for example, but also institutional funds that were previously only available if you had tens of millions and an account at a private bank. You had access to institutional funds, but now Endowus allows you to access these institutional funds at just $1,000. And so really democratizing advice and access and really lowering costs to a fraction of what the industry is providing at the moment. So Endowus is already the cheapest way to invest your CPF in money. It's the cheapest way to buy a single unit trust of any kind. So famous, like popular funds like PIMCO Income Fund or First State Dividend Advantage, all of these are available at the institutional rate, which is less than a third or a quarter oftentimes. Some of these funds are exclusive. things like ESG sustainable investing, which is a very popular space. Endowus has pioneered that space by introducing institutional funds like that were invested by GIC and sovereign wealth funds, and making that available to the retail audience here in Singapore in Sing dollars, made tax efficient with 100% trailer fee rebates or institutional funds. So it's really important to not only personalize, but also manage your money holistically. Not just look at the different buckets of money that you have. CPF is something separate, SRS is something separate, cash you do differently. You have to manage your money holistically so that you have a great picture of where you are and where you are headed and what is the plan to get you there. The first question of a poll that we wanted to ask the audience is, do you think investing with your CPF is even necessary? So you have your OA, which is giving you 2.5%, 3.5% for the first 20,000, and then you have your SA and RAMA, everything else that gives you 4% and 5%. So I think it makes a lot of sense for people to really maximize the opportunity that CPF gives you to compound returns over the long term. And it's our belief that 4 or 5% is wonderful returns, risk-free. But OA is a questionable, percentage, 2.5%. And I'll go into this in a much more detail about why we think this way and how individuals with different circumstances should look at it from a very, very personal perspective. Don't take the government or CPF or other advisors and anybody, even Endowus's advice on this. Look at yourself and see what you need, where you are headed, what your CPF is for, and then use it optimally for you and your loved ones. So for CPF investing, do you think investing with your CPF is necessary? I think we have an overwhelming response here of yes is 70% and no is 30%. So more than 2/3 have answered that we need to do a little bit more with our CPF and invest that to generate higher returns over the long term. What is the state of affairs in investing here in Singapore? OCBC survey is well documented that 1/3 of the population actually do not even invest. The traditional barbell strategy of FD and real estate is where a lot of people have managed their wealth. But to be honest, with deposit rates at such low rates and also property prices at historical high levels, how much more upside do we have? So I think it's really important that we learn from developed economies like the US or Europe and how the baby boomers and the previous generations have utilized proven, empirical, evidenced investment philosophies and processes to advance their wealth and prepare for a retirement adequacy that is probably the single biggest generational challenge we face as a society. We do need to do better, and we should not be speculating or not investing and not doing anything. We need to take action. We need to educate ourselves and get going on this investment journey. The other thing that really stands out here is investment not performing to their targets, and one of the major reasons is cost. Cost compounds just like returns compound negatively. And therefore, if you can improve cost, that is directly going to impact your returns positively. So you have to look at the cost structure of any investment product, any service provider, any advisor, any insurance-linked product that you feel doesn't really make sense. You need to look at the cost and reduce cost at every layer and in any possible way, because that's going to improve your returns. And retail individual investors have had it tough. If you look at the long history of retail investors, this is a survey by JP Morgan, over a 30-year period, the actual return on their accounts is 2.6%. What people do is they chase the market on the way up, panic and sell at the bottom, or they have too much cash and they don't invest all of their money. So in order to generate better returns, you need to invest a lot. A common thing that many people say is, oh, I invested in Tesla and I doubled my money. But the next question you need to ask them is, how much did you invest? Did you invest all of your money? It doesn't matter if you put $500 and doubled your money. You made $500. That's not going to prepare you for retirement. So it's really important that we look at this holistically and not make mistakes in terms of asset allocation, which is the most important thing. And it goes now to the point about what is the difference between saving and investing. So saving has virtually no risk, bank deposits and savings accounts, but it also gives you virtually zero returns, especially when you look at it from a real return perspective versus the cost of living and the cost of inflation. Investing is taking risk, but it gives you higher returns. So we need to understand, first of all, that investing and saving is completely different, and you need to look at your CPF investment also on whether your OA, your SA clearly is going to give you better returns, but your 2.5% in OA, is that for saving or investing? CPF is a pot of money that keeps piling up. But it's not a singular pension program. It is for housing, it's for education, it's for medical, and it's for retirement. So it's not just for retirement. We have to understand that. So the government and CPF is not going to solve all your problems. It's an amazing total social security system with amazing risk-free yield. It is what it is, which is an amazing tool. But people need to take more control and own it and really do better with what they have. And retirement adequacy is a major issue that we need to solve, and utilizing CPF is one of the best ways to do that. And I think this is a chart that Lou also shared yesterday about what CPF and the extra interest is. We'd like to point out that SA is something that we advise not to touch. But OA is why, is where I'm focused today, because it's questionable whether that 2.5% is going to enable us to reach adequacy. And the 2.5% is something that in the past was not a fixed number. For now, I think that we have pretty much certainty that the 2.5% will be there, but it's something that's revised every quarter. But the more important thing is life is getting more expensive. We all feel it every day. The long-term inflation rate is 1.7 to 2%, but it really doesn't reflect the accurate long-term rising cost of living. And if you generate 2.5% return, there's a slight spelling mistake here. It's not a new word that we created, negative, but it's negative. Negative real return is what you end up with if the cost of living is rising by 2.5% or more, and your return is 2.5% or less. So what you end up is you're saving $100,000, but after 20, 30, 50 years, you have the purchasing power of the same $100,000, and that's it. You're not increasing or saving or compounding the returns to generate better returns so that you can buy more things or maintain the quality of life that you had when you were working into retirement when you have no more income. And people hesitate to invest CPF precisely because of this, because they feel that it's a very bumpy ride to building wealth. There's volatility in the markets. But we have to understand this perception of what the performance actually is. So a lot of noise has been created by some publications about recent performance of CPF, the CPF investment scheme. So this was published with September 2020 numbers, but only this year. So this was October 19 to September 2020. And you have to remember that this is during the COVID crisis. So it reflects the massive market fall and a slight rebound in the markets. And during that period, this data for 1 year shows that there was almost 40% of the population that did less than 2.5%. 50% of the population that did less than 2.5% or lost money. And it's understandable because it was during the COVID crisis. But people look at this, it's not the amount of money, it's the number of members who lost money. And one of the biggest portions of this number is people who are punting stocks, people who still have their CDP account at SGX, which holds Singtel or old Singapore ex-growth companies. And as a result, during the COVID crisis, they did very, very poorly. Singapore Airlines, Singtel, and Singapore Post, etc. And therefore, this number is very myopic, it's very short term. If we extend that to just 5 years, more than 2/3 of investors actually made more than the 2.5%. And the remaining are suffering from either the wrong asset allocation, investing in the right type of asset class, or they're punting stocks or behaviorally making mistakes, or they're investing in unit trusts or insurance-linked products that are very high cost. So we have to look at this in the long term. And if we just narrow this down to just the investment funds that are available on CPFIS, this is the total number of CPF unit trusts and insurance-linked products that are made available by the CPF Board after vetting them and then allowing it in. So not all funds are available on CPF investment scheme, but these are the ones that are available, about 100 plus funds that are available. The average return for these funds over a 1 year period up to March of 2021 which includes March of 2020, COVID crisis, is an amazing one-year return. And 3-year, 5-year return obviously is, again, cumulative 25%, 3-year annualized return of every year of 7.77%. So the average performance of all the funds on CPFIS have actually done better than the 2.5%. If you look at it, if you break it down into the bonds, equity, and the mixed assets and money markets, 3-year cumulative, even the money market funds actually did better than the 2.5%. Not as good as the SA return, but it did relatively well over a relatively long period of time. And the most important thing here then is, what is the probability of success? And the simple answer is something that we can calculate very easily. And the longer you invest, the greater your chance of outperforming the CPF OA rate. Now, the way to look at your CPF OA and SA portion is, your SA is like a bond allocation. You're generating 4 or 5% completely risk-free. You should not be touching that and not be investing it, especially because SA, you don't have as much investment choice. But for your SA, that is going to compound over the long term for a long time. Some people top it up, some people don't want to because it locks in the money. But you can be rest assured that the SA interest rate is going to be an amazing compounding return for you. But that's a bond-like return. Your OA is where you allocate for equities portion, is the way we should look at it. It's the type of money that is locked up for a long period of time that will give you better returns. So let's look at the probability of success. Every period, since 1990, we look at the major stock market and bond and balanced indexes and how they've done over time. And these numbers are up to 2019. We need to update the numbers, but the updated numbers will give you an even higher probability of success. So this is a very conservative number. And the conservative number shows us that for a bond index, you would have outperformed or done better than the 2.5 almost 100% of the time after 10 years. For stock indexes, 15 to 20 years, you would have outdone CPF OA investments in a major way. And a balanced portfolio has given you even better results as well. And when we talk about risk and return, we're talking about volatility. And 1-year volatility, if you invest in the stock market, for example, in 1 year, obviously the market can go up 100%, or it can fall like 50% in the worst, and the best outcomes. If we do that kind of analysis in a rolling 1-year, 3-year, 5-year, 10-year period, if you extend that horizon to 15 years, you're never going to lose money. Because every 15-year rolling period, historically, has generated a positive return, never a negative return. And so people talk about the time decay of money, but there is a concept called the time decay of risk. The longer you invest, the more stable the returns become, and the volatility narrows over time. And the proper perspective is about time, right? Because when you're talking about your CPF money in particular, and SRS as well, it is a different pot of money. You're investing for a very long time. So if you're starting work between 20 and 30, 25 years, let's say at 25 years, how long do you have until your retirement age? That's 40 years. And then, when you're starting a family in your 30s, that's still 30, 40 years left. Even at the median age of Singapore, which is now rising to 42 years old, which is a pretty rapid aging that we're seeing, up to your retirement age, you still have 23 years. But what's important here is to remember that after retirement, the average life expectancy at birth in Singapore is now crossing 80, mid-80s, which means that more than 50% will live longer than that. And that's most likely going to be the well-educated, white-collar professionals and people who will live beyond that. And that is at birth. If you live until 65, the life expectancy extends itself to 87, 88. So we're going to live probably until 90 or even longer. At the age of retirement of 65, that's another 25 years. So even at the withdrawal age of 55, that's another 35 years of investment. At the median age of 42, you have 48 years left in your life to invest well, save well, and then, draw down your money in a major way. So I think that it's really important for people to have perspective on how long-term the investment horizon really is for individuals. And when you have time on your side, the effect of compounding accelerates in your favor. So the difference between a 7.5% long-term global market returns versus 2.5% over a 30-year period is the difference between 10xing your wealth and just doubling your wealth. And the doubling is just barely inflation, whereas 10x will compound your assets to a level where you can actually start drawing down in your retirement and maintain a quality of life that you deserve and your loved ones deserve. So this is a portfolio of an Endowus customer that may have been shown yesterday. This is, luckily the timing was great, March and April of 2020, but obviously, it's been a very steady return with your CPF OA portfolio. And the younger you are, you need to get going. You need to invest your money because you have to expect and ask for a longer period of return and better returns over time. Also, I want to touch upon SRS because CPF is not all you have. In addition to CPF, you have an SRS which allows you to set aside $15,300. If you're at a decent tax rate bracket, then you're going to save $15,300 worth of taxes at your bracket, and sometimes maybe even lower your tax bracket to a lower tax bracket. For foreigners who don't have CPF, and like PRs and Singaporeans, they are allowed to invest $35,700, which is an amazing large amount that you can offset on your annual tax break. And the investment horizon is 10 years. You have to keep it in there for 10 years. But then you can draw down with a very low tax rate especially after retirement. So SRS is an amazing tool that we have here in Singapore to complement and supplement the CPF to grow the pie and improve your chances of success in retirement. So with that, I'm going to have another poll question. What is your preferred choice of investment instrument? If you have to invest your CPF, what are the most popular tools? Stocks, individual bonds, unit trusts, mutual funds, ETFs, not very many available in CPF investment scheme, but available for SRS and other cash investments. And then obviously a historically very popular choice, insurance-linked products, which may not have given you the best returns, but sometimes gives you coverage. But also, I think there's been a real enhancement in the quality of the products that are coming out, because historically it's been a very, very poor experience with very, very high cost. So, we're looking at the answers that are coming through. Please click very quickly so that we can save time for everybody. So the most preferred choice of investment instrument is shifting even as we speak. And I think the most popular two are funds. So both unit trusts and mutual funds and exchange-traded funds equally have about 30% weighting. And then individual stock selection is another 25%. Bonds end up with 8% in insurance-linked products is now surprisingly down to less than 10%. But it's interesting to know this because a lot of it is equity-based. So stocks, unit trusts, ETFs a lot of them are, obviously they have balanced portfolios and fixed income portfolios, but equity-based. So it feels like the audience today is well-versed, well-educated, and they know this perspective of long-term investing and how volatility is reduced as we invest for the long term. And the younger you are, you need to invest in growth asset classes like equities to generate the long-term compounding of returns. And the equities market obviously is not the local coffee shop that has to shutter its doors during COVID. It is the best companies around the world that you're investing in. And so we need to be globally diversified. We also need to lower cost exceptionally in order to achieve success. And that's what Endowus is really built for, because it is a go-to wealth platform across all your source of funds. It's for your short-term cash savings. We need to make cash work harder for us. I don't see why anybody should leave any money in bank deposits when you have these wonderful tools that all the digital platforms are providing these days to manage your short-term cash. Endowus has something similar, which is Cash Smart. We have 3 products that are generating 0.something% all the way up to 2% to really push your cash to work harder for you. You can make more in a year than if you had kept it in a bank deposit over 10 years. So we need to do more with the short-term cash, emergency funds, rather than just keeping it in a bank. But also, we have other solutions, which are general investing solutions. And we have the FundSmart platform, which is the lowest cost platform to buy unit trusts here in Singapore, so that you can manage all of your wealth systematically. And we stand on the shoulder of giants with amazing key partners offering the best products. We curate it individually for the individual so that you can have a higher chance of success. And as I mentioned, the cheapest way to invest in a unit trust in Singapore. So with that, I'm going to save some time for questions because I didn't want to just talk myself and make it a much more interactive session for us. So I think we've had some questions that people have secured for us. What are the suitable investments that help sustain income for retirees? I think Lena did a fantastic job of talking about not only CPF prior to me from Money Owl. Lena did a fantastic job of explaining the many options and structures and plans that people should have to sustain income for retirees. I think one of the most popular products is an income product here in Singapore. There's many insurance-linked products or annuity products that you can look into. But the most important thing is do your own due diligence. Right? Don't rely on your financial advisor or your insurance agent to push products that may be unsuitable for you. So you know your circumstances better than anybody. If you can transparently share those things with your financial advisor, that would be amazing, wonderful. Endowus has hybrid investment customer advisors who are all licensed representatives who can advise you on your personal financial circumstances and your personal financial planning. And so there's a wealth of solutions and service providers who can help you with this. What investment options are suggested for SRS? So Endowus has an SRS portfolio which is globally diversified and low cost in nature. But you should also do your own research. SRS is much more flexible. So CPF has only 100 plus funds that are approved by CPF and included into the CPF investment list. There's only 5 ETFs as well. But for SRS, there is a much broader selection. It's very similar to your cash and a lot of flexibility. And that's the beauty of SRS. It gives you tax benefits and gives you complete flexibility in the way you manage your SRS savings. So SRS is something that I think everybody should do. And one of the important things is because it's locked in for 10 years, the moment you put in even $1, the clock starts kicking. And that cutoff is December 31st of every year. So before December 31st, now we're approaching October, so you have 3 months left to deposit even $1 or $10 or $100 into your SRS bank account. You can use any of the local banks to do so. And if you set that aside, then the 10 years starts clocking. So if you set aside $100 this year and next year and then start investing a bigger amount from there on, you can actually start withdrawing earlier than waiting until you have a pot of money to invest. So there's a lot of things that you can do with SRS and a lot of flexibility. Should I keep my money in retirement account instead of putting it into CPF Life every year? Which is the better option? I think CPF Life is an amazing and wonderful tool. It gives you annuity income into your retirement. What is maybe a little bit, maybe not enough for CPF Life is that if you have a certain standard of living and you feel that $1,000 or $1,500 or $2,000 is not enough for you, you have to do more because CPF Life, that is the maximum that you can receive on a monthly basis. And therefore, you need to do more with your SA and you can do more with your OA to build your wealth so that you can have a higher level of savings that you can withdraw from in your retirement. And one of the most important things is that the flexibility of OA becomes even more important. And the 2.5% guaranteed return is even more important in your retirement. Because after your retirement and your withdrawal age, you can use your OA as a cash deposit. You can actually take out your money at any point in time. You cannot put money back in, but that is going to give you 2.5% yield. When you're younger, 2.5% is not enough. But when you're older and you don't want to take risk and you've amassed a decent amount of money, like Lou yesterday has millions in his account, then you should be shifting it to an OA account and continue to invest a portion of it. But the rest, you can actually get 2.5%. So you can continue to use that until 80 or 90. So using your OA flexibly is the best option that you have. To what extent will Endowus be involved in the forthcoming lifetime retirement investment scheme? I think that the studies on lifetime retirement investment scheme has been ongoing for a very long time. It has not been implemented yet. The way we see it is Endowus has produced something that is even better than the lifetime retirement investment scheme and the options that we haven't seen the details, but from what we can gather, we have provided a private market solution for individuals to plan out their lifetime retirement through investment, which is what LRIS is supposed to do. So we hope that Endowus is a viable and good and robust option. We've lowered costs from above 5% for unit trust to less than 1% all in a globally diversified, often passive index funds. So it is the best option we have for investing your OA at the moment. We hope that other people will join us so that we can enhance the experience for everybody. Question from Jocelyn Tay, should we consider dollar cost averaging on a monthly basis, or is it okay to put a lump sum every year? So this is a question that is asked very, very frequently. And I think that there's a scientific, empirical, data-driven answer. And the answer is that lump sum over a long period of time, if you look at empirical evidence and scientific data, is always going to do better than dollar cost averaging. And the reason is because the market is trending. So the markets compound and give you a positive return. So the later you invest your money, obviously the returns are going to be lower. Obviously there are volatilities, but if you think about it, you're 30 years old, and the amount of money you've saved, whether it's 50,000 or 100,000, versus all the money you're going to make in the next 20 years of working is only a fraction. So we think that we're investing all of our money, but we forget about all the money that's going to come in the future and the CPF monthly contribution that comes in. So what's important about dollar cost averaging is not that it results in better outcomes or returns. It overcomes our fears and behavioral biases so that we can introduce a system where we can invest every month an amount that is suitable for you so that you can keep building your wealth and build for your future. So that's why dollar cost averaging or a regular savings plan or having a system in place to invest your money is the most suitable option for you. Not because it's it generates better returns. Maybe we have 2 minutes left. We can just do one more question. The top question we have is how much percentage of CPF OA would you advise for a 54-year-old to invest? If you already have FRS, full retirement scheme, then how much percentage? Well, it goes back to, I think, the perspective of time horizon. At 54 years old, you're expected to live another 20, 30 years. It depends also on how much money you have set aside in other savings other than CPF. But if you have some buffer in other cash savings and you have SRS or other, and you have a full retirement scheme, FRS done, then you should be investing a meaningful portion of that. It doesn't have to be 100% equity. It could be 60-40, a balanced portfolio, or even a 40% equity, 60% bond portfolio. But you should always be as invested as much as you can in your CPF because you have a buffer with cash and other investments that you have around you. So with that, I'll wrap up today. And thank you so much for having me. And it's wonderful to be here. Thank you so much. Have a wonderful day.